Great to have you here, Paul.
Thanks for having me.
All right, so 2020, economy connecting to M&A.
Yep.
What's the relationship between the two?
Well, that's a great point. Historically, M&A has been a leading indicator of the economy.
Okay.
Credit Suisse, I think, historically has reported about an 8-month lag from when you saw a drop or a decline or a deceleration in M&A for the broader economy to kind of follow along that. And historically, leading up to the dot-com boom, leading up to the financial crisis, we generally saw that. Today, I think things are different. I think I was telling you earlier, I'm generally bearish on the economy going into 2020, but I'm bullish on M&A. If you look at the data going back into 2019, there's actually been a deceleration in M&A. I think global M&A transactions announced are down a little over 4%.
In terms of number?
In terms of volume.
Okay.
Not value, but volume.
Okay.
And, but look at what, an example in the U.S., look at what the U.S. economy has been doing.
Yeah.
If you look at deal flow, particularly in the second half of the year of 2019, private equity deal flow was off about 20% from the quarterly historical averages, yet the market is at near record highs. So what's really driving that? So we're seeing something, a phenomenon that we really haven't seen before. I'm calling it sort of a decoupling of M&A from the broader economy, particularly in the United States.
Now, why do you think that's happening? Is it just because the economy has been so unique for the past 10 years where it seems like we've had fewer, big booms and busts, the economic cycle kind of compressed as we've had low rates, maybe not as clear. We've heard, people saying late cycle for 4 years, basically, right? So is it that the nature of the economy is changing, or is there something happening for the companies in M&A?
I think it's both, to be honest with you. Like you said, the economy, having all these record highs, there's a bunch of things that have been driving that. The things that you hear about: tax reform, corporate earnings, deregulation, low interest rates, low inflation, record low unemployment, all good things. We even have some certainty now around a phase one deal with China, and as well as even the vote on Brexit. So there's a lot of good things that are taken out. But then look ahead, okay? I think there's something that we probably aren't going to expect that could derail the economy, okay? Iran is the most recent thing. Oil prices, we still have to get the deal done with China. What are the details around Brexit? We're heading into an election year, right, which is uncertainty in and of itself. I think when you look at things like consumer spending, which is, people like to point to that in 2019 as a major driver of the economy, and it is, but Deutsche Bank research just came out and said, half of the population of the United States spends more than they earn. Okay, and low interest rates are just kind of adding fuel to the fire of that. So I think we're setting ourselves up for something that's kind of a little scary. Now, when you look at M&A, when I talk to my clients and our clients at Alvarez & Marsal all around the world, the message is clear. The issues for them are high valuations and competition for deal flow. As you know, the alternative investment class, money's flying into that, lots of competition for deals, driving up valuations, and the public equity markets aren't helping.
Banks basically competing to do the deals and that driving up the value?
Well, private equity funds, sovereign wealth funds, family offices, corporate acquirers. There's a lot of people in the space, limited partners buying direct, that are, with the capital flowing in, the liquidity in the market. Banks, commercial lenders providing readily available financing, but then you also have alternative financing sources, all this private capital, private debt funds that didn't exist back during the financial crisis. So it's kind of a perfect storm to drive up valuations. So a lot of our clients are kind of sitting on the sidelines. I mean, I think dry powder, which is capital that's been raised and needs to be invested, is at $2.4 trillion unlevered globally. That's a record high.
How do you measure that?
It's all the capital that's been raised, fundraising as far as committed capital in private equity, sovereign wealth, family office. You add that up globally around the world.
It just hasn't found a deal yet.
Yeah, it's raised, committed, but not deployed. Okay, that's dry powder. So what we're seeing and what our clients are telling us, they almost welcome some type of disruption to bring valuations down.
Okay. Why don't they just use their stock prices to do the deals?
Well, not every...
Stocks are high. They can do stock transactions, right?
Well, corporate acquirers have had an advantage over private equity in the last year or so because they've used stock as a currency.
Right.
That could flip, though.
So you're talking buyout potential as well.
Both, yeah.
Take private situation, too.
Correct. Okay. And then you have things that are sort of driving no matter what. For example, digital transformation and technology, right? That's going to create deal flow depending on what side of that equation you're on. If you want to compete with a new technology, you're going to be an acquirer. If you're looking to get out of a business that you clearly think you can't compete in because of technology, you're looking to move out, and that creates selling opportunities. But I think we also look at fundraising activity, and over the last couple of years, there's been huge increases in funds that are raised to deploy on deals for distress deals, special situations. That hasn't happened yet. Everyone's waiting for the shoe to drop on the economy, and we're in this record bull market.
Right.
But there's all this capital that's pent up. And I think just sitting, look at Berkshire Hathaway and look at what Warren Buffett's saying. He's sitting on 128 billion of cash because he can't deploy it because he thinks valuations are too high, and he's a value investor. So that's a perfect example.
Yeah. One of the things is my favorite things to think about M&A is whether or not a deal is done out of necessity or kind of strategy. And it's kind of a thin line to draw sometimes, but of some of the deals I feel like that we've seen over the past couple of years, some of the big mega deals too, like an IBM buying Red Hat, is out of necessity because they just couldn't, jumpstart this part of their business enough on their own, as opposed to say a Salesforce that goes out and is constantly strategically acquiring small companies to build a moat around itself that's already there.
Correct.
Energy stocks right now, we hear people more and more talking about there having to be deal activity there. So banks, regional banks that have to get scale. Where are going to be the places that deal activity happens out of necessity? Because if the economy is slowing down and the vision of what happens this year that you're describing comes to fruition, I would imagine a lot of deals will happen out of necessity.
Right. Right. Well, when you look at from a necessity standpoint, I think that's a great point. It's probably more the troubled industries. Energy will continue. I think you'll see consumer and retail. Those are still attractive assets, at the right valuation, and people have unique strategies around them. I think automotive could be one that you're seeing. I mean, there's a whole host of.
We've talked about this one before.
Yeah,
I
think automotive is one that you could see. I don't think it's happened yet, but I think we're headed in that direction, and we're clearly seeing that with some of our clients at Alvarez & Marsal. So those are some industries that I think would be out of necessity.
Okay.
But I also think taking corporate acquirers out, going back to my point about that dry powder that's been raised, the folks that do that, private equity, sovereign wealth, family office, they are in the business of transacting. So there is some necessity even on their end to deploy that capital, no matter what. You can't just raise it and sit on it. You return your capital to the LPs or limited partners or the investors. You're never going to raise another fund. They want that deployed, and there's a cost of capital if it's sitting there being raised and not yet deployed.
Yeah. What about the retail space? I think about even a Nordstrom, which a year and a half, 2 years ago, rumors about the family taking it private. We've seen bankruptcy still happening in some of the multi-channel retailers. Is there going to be consolidation there, or is this just an industry where people just, businesses die and they go away? I feel like there hasn't been as much M&A as one might think.
No, I think what you're seeing in retail in particular is a shift. I think everyone's like, oh, well, retail doesn't have brick and mortar and everything's moving online. It's not 100%, right? I mean, I think what you're seeing is a kind of a right sizing and people adjusting to what the new retail normal may be. So it's downsizing, some of the retail footprint. But look at some companies are going the other way and actually opening brick and mortar. For example, Tesla is opening brick and mortar to showcase the cars. Another great example is Peloton, right? That started online, and they're actually opening showrooms because people want to.
Heck, Amazon's everywhere now,
right? So it's finding that balance. I think everyone's rushing to judgment and saying, oh, all retail is moving online. I don't think that's the case. I think it's right sizing. More of it is going to move online. So during this period of disruption, during this period of change, that breeds opportunity for the right investors.
A lot of these companies that went public last year struggled a lot. I'm curious about the potential for not necessarily the most recent IPOs to either go private or get acquired, but we've already heard talk about maybe Slack getting acquired. If a company just IPO'd in the last 2 years, does that necessarily mean that they can't be involved in a takeout?
No, it doesn't mean that at all. I mean, every company is different. Every company is unique, depending on the timing of when they went public. Some go earlier, some go much later stage, right?
Yeah.
The need to go public isn't as great anymore when there's so much private capital available.
Yeah.
So no, just because you've IPO'd in the last year or two, maybe it wasn't the right move. There's a lot of cost, a lot of regulation around being a public company, and some companies may change their growth strategy, and they're better to effectuate that as a private company.